over the last 10 years, the PRI has managed to grow to 1,500 signatories, and it accounts for about $60 trillion worth of assets. And what's most interesting is that the panelists up here are going to explain a little bit about how the PRI has shaped their views with their investments, and whether or not over the next course of over the next 10 years, just what the focus is going to be in terms of improving the world and improving society through investments. Joining us here today are 3 investors as well as 1 representative from the Department of Labor to give us an overview of impact investing so far. Immediately to my right is Geeta Aiyer. She's the president and founder of Boston Common Asset Management. Beside her is Priya Mathur, a board member of the California Public Employees Retirement System. Judy beside her. She's a Deputy Assistant Secretary of the U.S. Department of Labor. And finally, Keating, who's the President and Chief Executive of Commonfund. Thanks for joining me this afternoon. So, Geeta, just to start off with you, would you like to tell us a little bit about your first experience of being a responsible investor, and how has being a signatory supported this?
So, I want to thank PRI for coming onto this stage and galvanizing this effort. But in the United States, for a long time, several of us had been doing this kind of work. I hate to admit this, but I started in 1988 doing this kind of investing. And what drew me to it was that I had come up the ranks as an analyst and a portfolio manager. I realized that so much of the value of a company dividend discount model, 70% lies in the terminal value, which is 15 years out. So the long term is embedded in finance. It just had to be pulled out or drawn out. And thinking about what regulation would be, what competitive dynamics would be, and consumer preference long term would be was already in finance. But when I started a company in '94 to be a global equity investor, the information about what was going on in emerging markets in particular, no matter where the company was headquartered, what was going on overseas was not well understood or monitored. So we had to create primary sources of data. We had to create our own rules, trade-offs, build networks of sources of information in local language press, all that kind of thing. We had been doing engagement for a number of years. In fact, the movement here began with the religious leaders within the United States. We built coalitions. We did things to magnify our voice and built a credible tradition of engaged ownership. But in both those areas, PRI coming on board meant that the Emerging Markets Disclosure Project was launched. One of my colleagues, Lauren Compere, co-chaired that. So there was a structured way of gathering information and leveraging that in a very more systematic way. And also, the clearinghouse of PRI engagements was created, allowing all of us to both do more and at the same time gain scale and access in a way that was beneficial to all, allowing us to focus on our core competencies and yet at the same time leverage this. So in a number of different ways, PRI has brought legitimacy, but also a button-down, strength in numbers, and a real credibility to the effort.
Thank you. Priya, as a founding member as a founding signatory of PRI, would you like to talk a little bit about how the principles have guided Calpers' investment values and ownership practices?
Absolutely. Thank you. So Calpers has been engaged in sort of active ownership since the mid-'80s, when we first got involved in corporate governance work. And what we learned from that was that these types of issues around how companies are run and governed really do have a financial impact for those of us who are investors in the marketplace. And over time, our understanding of that broadened from just purely the governance of the company to other issues, environmental issues, social issues, all of which can have an impact on the ultimate performance of the company and the performance of our portfolio. And so Calpers participated in 10 years ago in the sort of the development of the principles for responsible investment. And then I was lucky enough to stand alongside Kofi Annan and many others on a very small balcony at the New York Stock Exchange to ring the bell at our launch. How has PRI really impacted how Calpers does business? It actually is incorporated into our global governance guidelines. And it's one of the only sets of principles similar to those that are incorporated directly into how we do business. And at Calpers, PRI has been particularly useful in our ESG integration work. I'm sure all of you know that PRI produces lots of asset owner-specific and asset class-specific information around how to integrate environmental, social, and governance factors into your investment decision-making. And a lot of that has helped to inform how we do it now at Calpers. So one other thing I would like to mention is the Montreal Pledge, which we signed on to a couple of years ago. And we thought it would be interesting, that we'd learn something from it, but that it was really just a signal to the marketplace about how important climate change is to investors. But what we discovered was actually quite mind-blowing. And that is that 80 companies out of the 11,000 companies that we invest in globally, just 80 drive 50% of Calpers' carbon footprint. Now consider that for a moment. It's an infinitesimal percentage of our portfolio in terms of the number of companies, and yet its magnitude and its impact is so substantial. And so that is now, we're now integrating that into our ESG strategy, and engaging those 80 companies is going to be a central focus for us over the next 5 years or so.
It's very interesting. Catherine, Commonfund's a newer signatory to the PRI. Could you tell us a little bit about what motivated Commonfund to sign on, and a little bit about the perspective that you may have over the last 10 years of what PRI has done?
Sure. So Commonfund has been a signatory of the PRI since 2013, so for 3 years. We are an asset manager, and most of our clients are nonprofit and public sector investors. And when you think about that investor segment, they probably have the longest term time horizon of any group of investors in the world. And so, the kinds of things that we're talking about today, ESG, climate change, those sorts of things, over very long time horizons are probably going to impact investors. So it's something that's very important to our clients. It's actually been something that's been, sort of part of the fabric of our firm since we were founded. I went back and I looked at our first annual report to our investors back in 1972 when we were talking about the responsibilities of corporations. So it's been part of the way we think about things, part of the way that we assess investment opportunities. And I guess I would say that since we became signatories, we've done what you would expect signatories to do, which is lots of research and analysis and education and engagement with our clients and with our managers. And now we're focused on, really implementation. And again, for our clients as nonprofit and public sector investors, they're fiduciaries. They're subject to a fiduciary standard. And so as we approach implementation, it's always with sort of a financial lens and the fiduciary standard, which is the fiduciaries have to optimize risk-adjusted returns over time.
Great, thank you. And Judy, you were an investor, and now you're on the other side. You're a policy now. What factored into the decision to become a PRI signatory, and how has that shaped some of the policy work that's happening?
So I brought a prop along because there's nothing like a prop to tell a story. You've all seen this document. And there's nothing like the global community talking to your president, who talks to your labor secretary, who talks to you and says, in here is a recommendation that says, Department of Labor, you should do something. You've set out some regulations for your ERISA fiduciaries, those who are fiduciaries for managing corporate pension retirement assets. And we think they've been detrimental to the pursuit of good global practices. Have a look. So one day the Secretary of Labor shows up in my office and said, Judy, what's the fuss? You're an investor. Figure this out. So we took the approach that any good researcher would do in saying, well, what's going on? We looked at the principles. We looked at the number of people that had signed the principles. We looked and said, are there any ERISA fiduciaries in there that have signed? Yes, but not many. But yet their money managers to whom they've delegated the responsibility for managing their portfolios had signed. We called US SIF and said, what do you know about data? And they said, there used to be $200 billion invested in ESG assets. Today it's $4 trillion. And so we sat back and looked at what the facts told us. And the facts told us that the market had in fact changed. And our guidance had kept ERISA fiduciaries on the sidelines, not because we literally said this is bad. In fact, we said exactly what Catherine says. We're looking at the economic interests, but we put some language around guidance that said, look at the economics, but, you may want to do some extra work, you may need to. So we've said things that put a chill on what we thought drove economics. And I will say to all of you who've done this research, thank you, because we couldn't have taken the steps we've taken without the data that says when you look at sustainability factors, it actually affects the value of a company. And when you look at funds that invest with sustainable practices, it makes a difference in their results. So the ability for us to ask was A, asking the question to the right people, but B, also having the results that drive good policy.
Great.
So we tried to take our thumb off the scale.
Thank you. So next I want to get into a little bit about how do you measure the impact in tracking these investments, as well as non-financial investments. How do you measure the impact and performance to make sure that impact investing is working out in your portfolio as you want? Priya, I'd like to start with you just a little bit about what Calpers does to measure that impact.
Sure. So for a long time, we've been measuring the impact of our corporate governance activities. And in fact, what we've learned that our corporate governance activities have been so successful that we've now changed how we approach corporate governance. So what we used to do is we would publish a focus list, make it very public, name and shame, and then try to negotiate with companies. Now, we develop a focus list, keep it private, engage with companies and their boards and executives, and we bet on those companies. Because what we have learned is that actually these companies, once we've engaged with them, they tend to outperform. So their performance is lacking in the 5 years prior to our engagement, and then performance improves significantly following it. So we're actually putting our money where our mouth is. But we're still hampered a little bit by what's available in terms of disclosure and information in the marketplace, and that's why we are so strongly supporting the Sustainable Accounting Standards Board's efforts here in the U.S. And hopefully more globally ultimately. Because we see that as really important to be able to compare company performance within industries with real relevant, quantifiable information. It's not everything, but it is, I think, an important next step.
Thank you.
I'd love to just support what Priya just said. We've long believed that we engage in order to improve the fundamentals of the company, not necessarily just to make a non-financial impact. It may appear in the beginning like that. If you manage your water footprint and you gain community consent to operate, eventually it shows up in continued operation, no management of that risk. And ultimately, we believe we improve the fundamentals of the company, which, when the market is efficient, ultimately get priced and a company gets re-rated. So to the extent that we monitor our impact, we are doing it through the engagement side. We also look at the Montreal carbon footprint and the kind of investments in solutions. But clearly with tradable securities, I believe the biggest impact is through continued engagement.
Thank you. And Catherine, how does Commonfund measure that?
So again, our standard is the fiduciary standard, and we have to be able to measure everything. And maybe I'll just start with a little story, if you don't mind. So I joined Commonfund about 14 months ago, and I spent my first few months on the road doing a listening tour, going out and meeting our clients, our investors, cities all over the country. And I came back after a few months after having been in probably 10 cities, and I said to our folks at the office, I said, every single city I was in, I got a question about ESG broadly, but in particular about E. And then if you think about our clients, nonprofit investors, many of them colleges and universities, the question about the environment, carbon, all of that coming up. And I came back and I said, we have to think about this, but I'll confess I approached it with a fair amount of skepticism, saying, if you're going to reduce exposure to, say, fossil fuels, aren't you going to decrease your investment universe, therefore decrease your opportunity for return and increase your risk? And aren't those two things exactly the opposite of what we ought to be doing? And so we took a team offline actually to start measuring ESG factors and results. And one of the things that we learned is that the E S, and G factors all behave differently. And in fact, it is, E is more measurable for a variety of reasons, although still room for improvement. G, the data is becoming more consistent, that, good governance leads to good, shareholder outcomes, cost of capital over time. S, frankly, is sort of the messy middle in many ways with a lot of special interests. And so we have approached all the work we've done with this lens of our clients are responsible for optimizing risk-adjusted returns, and where we think it's clearest today for a whole variety of reasons, some of which were already discussed by Mary and Michael, is probably E.
Thank you.
I should highlight that there's been a lot of work done in this area. US CIF has done work on this. The Croton Institute, there was a group of early money managers that we were one of them, funded and founded an impact of equity engagement format. So there are increasing formats for actually measuring impact, as in what change actually resulted, so with key performance metrics. And now, of course, PRI will add key performance indicators to that.
And Geeta, I mean, how would you compare that to, say, just 10 years ago in terms of the reporting? I mean, you mentioned that there are these forms, there are these tools now that can help investors. What did investors have 10 years ago to sort of to measure this?
In terms of just the impact aspect of it? I would say that the awareness of needing to measure and demonstrate impact has grown. We were always aware of it, but we were kind of caught up in showing that the portfolios, to your point, to show portfolio characteristics in the traditional ways. We would kind of struggle. We wanted to be more buttoned down than buttoned down. As women, I think we can all relate to this. But we've always had this: can you be sustainable -investor? Can they both be the same? So a lot of our focus had been on return on assets and return on equity, and traditional metrics of portfolio characteristics. And with the creation of both the appetite for this type of information and Montreal Carbon Pledge, and sort of more standardized formats that, again, allows many to report on the same metrics and therefore makes the data more accessible and possible to use. We've all, I think, evolved our own metrics initially, and hopefully now will then converge into more shareable paradigms.
Thank you. Judy, I'd like to start with you in the next question, but what role should U.S. investors be playing in impact investing and making a change? And is it even something that you feel, your opinion, that U.S. investors are broadly interested in?
So it's interesting. When I said that the ERISA investor was on the sidelines, they truly have been on the sidelines, so they think. When money has been delegated to any one of the money managers in the room, actions are being taken, but the communication between the investment firm and the investor isn't quite making clear the extent to which they evaluate sustainable, whatever ES or G factors we want to talk to, and its impact on their analysis of a company, of a management firm, of a mutual fund. So getting the data, I know we're all going to have the same data theme, but truly, if you don't measure it, you don't manage it. And the extent to which the investment community is measuring, having that communication come to their investors will be very critical for their activism, because if they don't understand the depth of the issue and how it affects the economic value, they're not likely to act.
Thank you. Priya, in terms of Calpers, I mean, how do you view, especially with your constituents, the interest that they have in impact investing and the role that they're playing?
So clearly we have a responsibility to our current retirees and to our future retirees. But we also have a responsibility to our future active employees who will, in the far future, become retirees. We are a perpetual organization, we hope. And so we just cannot afford to ignore some of these really long-term systemic risks that might take a long time to be borne out, but could have really profound implications for our future ability to perform as a portfolio. And so we think we do have a responsibility. We think we have a responsibility to act not just alone, but to also act in coalition with other likewise long-term, like-minded investors. And we've been doing more and more of that. So we don't really see ourselves as sort of the lone voice out there any longer. And PRI has had a lot to do with that. But we work collectively. And I'll give you an example. You probably have heard that we are right now very actively campaigning at many fossil fuel companies, including Exxon and Chevron, Noble Energy, Anadarko, to basically ask them through shareholder resolutions to ask the right questions around what would their business model look like in a low carbon economy. Something that many of them have been very resistant to doing. Last year we had success with BP and Shell, and we're hoping to have even more success this year in that regard. One of the things that we have seen internally at Calpers is that there's sort of this healthy tension between the skeptics and the believers, and it's necessary to help sort of move the organization forward, to have robust conversations around this very complicated set of issues, and about how we as an investor can most effectively be engaged around these issues. It's not always so simple, and we've had missteps along the way, but we still fundamentally believe that we do have a role to play, and that part of that is doing research, talking to other asset owners in the space, and developing what is the right strategy. And that's something we're doing right now around the issue of income inequality, for example, where it's clear that there's an economic cost to the current state of income inequality in the US and globally, but it's not entirely clear what we as investors can do about it. And so that's something we'll be exploring over the next few years.
Mm-hmm. And in terms of those conversations with other investors to sort of, I guess, get some sort of plan together or a way to tackle it, I mean, what sort of step would you take to sort of kickstart that? I mean, that's a complex issue, income inequality, and getting to a point of being able to solve that, obviously not going to happen overnight. But just out of curiosity, I mean, what were some of the initial steps that you took to take on, as you start to take on this issue?
So, increasingly, in just sort of daily conversations with other investors, this is coming up. Many investors are sort of struggling with this issue. And I'll tell you, PRI has really stepped up to it's identified this as an issue. And PRI has been a great convener of like-minded asset owners and asset managers around these types of issues. And in fact, I think in June we're going to have a roundtable at our London 10th anniversary event, specifically focusing on this issue and sort of trying to hopefully kickstarting a series of dialogues. Mm-hmm. So, convening people, thought leaders, both practitioners, academics in the same room can be really helpful. And we have tried to sort of help sponsor research and also sort of bring minds together. And I think that helps forward the cause for everyone.
Great, thank you. Catherine, would you like to talk a little bit about how U.S. investors are going to be, how you're getting them more motivated and how they should be motivated toward impact investing?
So I guess I would say what I've learned in focusing on this with my colleagues is, sort of the way to get started is to, I think, try to combine two things. The first is obviously something that's measurable, right? We've talked about that given fiduciary responsibilities. But the second is to combine it with something that is meaningful to your institution. And if you put those two together, that seems to be the combination. And again, for our investors, so many of them in the science field, universities, that sort of thing, it was very clear that the issue that was most meaningful to them at this moment has to do with fossil fuels and carbon. Students, as we all know, care about these issues, science departments, et cetera. And so it also lends itself, as I said, to measurement. And so as we approached this, we said, well, so what's happening in the world of fossil fuels? And what we really found were sort of two extremes, if you will. On the one hand, there were a group of investors that said, just divest from fossil fuels. And we sort of asked ourselves, that's a very blunt tool. It has very immediate impact, but it's a very blunt tool. And is it, actually accomplishing the whole goal of reducing greenhouse gas emissions? I mean, maybe it's really attacking reserves, but perhaps less effective at actually getting to the emissions. On the other hand, you had a group of investors that were saying, I'm not going to divest, but I'm just going to engage with all the companies that I invest with all the managers that I invest with. I'm going to raise these issues, and certainly signatories to PRI, we all engage. But we asked ourselves, that feels perhaps somewhat diffuse and as though it will have an impact over the very long term. But as we know, developments in financial markets seem to happen very, very rapidly today. We've already talked about the impact on the coal industry, how swift and dramatic that's been. And so our focus has really been to say, is there something in the middle, in between, divestment on the one hand, engagement on the other? Is there a path in the middle that will actually support the lower carbon future that I think we all aspire to, and that regulators around the world are going to probably ensure that we have? And our conclusion has been, yes, there is, but it takes a lot of data and a lot of hard work, some negative screens, some positive investments, some risk management, because when you exclude things, you change the complexion of your portfolio. But we've concluded that there is actually a middle ground that will substantially reduce exposure to emissions and reserves and still meet the financial requirement the fiduciaries have.
Mm-hmm. And just to supplement on that side, I think the engagement aspect especially spans industries beyond fossil fuels alone. So clearly our big effort has got to be in the transition to a low-carbon economy, towards efficiency and better use, to the highest best use. Carbon should be emitted to that, and that's a win-win for investors to be engaged with, companies on. And then on the financials, on banks, on insurance companies, carbon risk resides not necessarily where carbon resides, but really where they haven't factored it in. So again, it's to the systemic security of the financial system, which the previous panel also spoke about. Clearly, we need to be engaged with them. So I believe the really important voice is going to be that of the financially aware voice that enables a company to then look through and take this as not just some sort of antagonistic discussion, but really one of collaboration. So tempting as it is to measure things like shareholder resolutions and proposals filed, there's actually real impact to be had from these kind of conversations where change can come about.
And I think this is really evidenced by the fact that NACD, the National Association of Corporate Directors, is now offering training on how to productively engage with active investors. So this is not just outsiders trying to engage reluctant companies anymore. This is now really evolving into more of a partnership between investors and corporate boards and executives.
Thank you. Judy, would you like to talk a little bit about how investors can better engage with policymakers, and then maybe a little bit about how policymakers can perhaps better engage with investors on some of these issues?
So I know this is going to sound like a broken record, so I'm going to apologize in advance. But I think everybody wants policy that's based on good data. And one of the challenges that we face now is that we really don't have comprehensive and consistent good data. We're making great steps. We're making great strides. But until we have the consistency of conversation, I think it's very hard to advance. And so I think to all of us, we need to think through where are the gaps in the data we have? Where's the inconsistency? How does corporate America engage in the production of data? It's great when the shareholders ask. It might be great if we had a regime that required some consistent disclosure. But the foundation of good policy has to be data. And that's where we think that the investment community can provide good strides in self-development, because nobody likes government telling them what to do. So if you don't want someone to tell you, yet you know that that's an essential force, my recommendation is let's develop what we need to make good policy.
Mm-hmm. Thank you. Geeta, would you like to talk a little bit about just what's driving some of the changes that we're seeing today?
Absolutely. In addition to PRI, of course, on whose board Priya and I serve, and the host of this event, and whose birthday we are celebrating, we have a number of forces at work. One is the beneficiaries. I think that came up repeatedly. Clearly, we have a responsibility as stewards of assets to transition those assets to the benefit of those who come in the future. And so the aspect of the quality of what is being left. In other words, investment guidelines today have done a good job of protecting the purchasing power of assets, so protecting against a systemic risk of inflation that we put in place several years ago. But now we are faced with whether the quality of life and the basket of goods and what level of that will be affordable by the beneficiaries of these assets. So clearly the beneficiaries, but then on top of that, to create urgency, there's the millennials, much talked about, 75 million of them, to rival the 75 million baby boomers, and the transition of wealth also in the hands of women, which someone cited to me as a motive force, and looking at this panel, I have to agree with that. And finally, I believe the progressive inclusion of all under this big tent. So what has started and become a bigger movement in Europe, for example, needs to have within it the United States, Asia, parts of the world that are not yet in it, in order for this to have real meaningful impact. And I think that's what's going to ultimately catalyze the I actually am more optimistic, Judy, in that things like FASB, modern portfolio theory, all these seem like a forever thing to us, but they're all products of the 50s, 60s, 70s. And then, mutual funds, ETFs, all of these start, ERISA, all these start to seem like pillars of society. But they weren't that long ago. So I think that once the movement starts, things fall into place like dominoes. And there will be iterative processes between data and policy, and I'm hopeful. I'm very optimistic on this.
Well, and I think if you look at the transformation in retirement savings we have, the voice of the institutional investor was very loud under a defined benefit structure, and we've had this massive transformation to a defined contribution structure, where individuals are responsible for their own investments, vastly facilitated by their companies' 401k plans. But I'm not convinced that each of these individuals know what they want to ask for. Yeah. They know, I have a millennial daughter. She definitely has an opinion about where she shops, what she eats, what she buys, what she wears, and who she wants to do business with. Now, she hasn't amassed a tremendous amount of assets yet, but as she's in an asset accumulation phase and she knows the influence of her investment dollar on her life and the ability to do well and do good at the same time, the demand will come, because this is a force in our economy that's only going to grow.
I also think we can't ignore the role of labor in helping to sort of bring some of these issues to the fore. And clearly labor has played a significant role in climate change, in human rights issues globally, in the fight for 15, which is just won some acceptance here in New York and in California, where over the next few years you're going to see a rise in the minimum wage. But they've helped to draw attention to some of these, the connection between investment issues, financial issues, and social and environmental and governance issues. And in fact, there's a new report out, the Responsible Investor Handbook, that is just come available, and PRI helped to support the development of that publication.
Oh, great.
As I did my listening tour, talking to all of our clients across the country, it was very clear to me, at least with the nonprofit investor, there were really three sort of main drivers that were leading, I think, to these questions. And the first one was mission. For some nonprofits, you might be a conservation organization, a wildlife organization, something like that. Some of these factors are just central to your mission. So you're asking because of that. A second one was, your constituents. You're a university, and your students and your professors and your donors it's important to them, and they're asking you. But the third, and the one, again, that I said we focused on really is, investment committees, investors, thinking about their obligations as fiduciaries and how you need to take some of these factors into account just from the traditional risk and return perspective. And they seem to me to be sort of the three areas that were driving it for our clients.
Mm-hmm. And Judy, you mentioned the need for big data to be uniformly collected to really help drive change. Are there any other points that you would add in terms of helping to achieve that and pushing through the next steps of impact investing and seeing some change?
Well, I find it interesting, Catherine, when you talk about the fiduciaries, and I've lived most of my life not as a regulator but as an ERISA fiduciary, and the ability to make top-down fiduciary decisions is vastly limited by our understanding. And that I have always said we as ERISA fiduciaries will come to our policy conversations from the bottom up, which is why I keep harping on the theme of data and communications between the investment community and the investor. That I think that it's the fiduciary standard for an ERISA fiduciary is a high one. And the concern is we've engaged with many people across corporate America is the concern that coming to the fiduciary conversation is so embedded in a political conversation that their investment process will become politicized, which is why I think we can take the politics out of the conversation if good data drives the conversation.
Mm-hmm. No, I think that's very true. I mean, and we saw a lot of the rhetoric around the Labor Department's most recent unveiling of the fiduciary retirement rule, but just how it seemed like a lot of firms did support fiduciary standard, but there was the arguments over some of the finer details around that. But like you said, it's something that could be more empowering or should be more empowering for retirement savers going forward.
I think this is I think the train has left the station. Mm-hmm. We are all on this train, and we are on this train together. It's the question of how fast is the train going, and that I think there are some very motivators, and I think UNPRI has been a very meaningful motivator of the rate at which this train is moving. I think everyone in the room is clearly engaged to make it move faster. So we think from our standpoint as a Labor Department regulator, we took our thumb off the scale. But we're not about to put our thumb on the scale in the other direction.
Mm-hmm. Well, if I could, I agree with you that data is important, and we spend a lot of time looking at research at Calpers. But at some point, someone has to have a theory that then must be tested in the markets, in practice. And then you assess whether that has actually performed the way you expected it to. And until you do that, you actually don't have any data. Mm-hmm. So you have, it's sort of this healthy tension there that you actually have to try things. You have to have a set of beliefs that guide you in one particular way, and you take some action and see how it pans out and adjust. It's an iterative process, actually.
And I believe that analysts, investors have a really big role to play in this, both in responding to data, but also helping create it. Ultimately, we're analysts. Somebody gives you an annual report, you know how to take it apart. I mean, so you don't depend on it for all your conclusions. You actually, apply yourself towards that. So we have to change the way we model the probabilities, the outcomes, change the discount rates on things so that we don't act as if the long term doesn't matter, and that the reduction in potential economic growth through ecological borrowing and economic borrowing is not going to reduce the ultimate world's GDP on which all of the earnings ultimately converge or earnings potential converges, and on which we have a claim as equity owners. So it's finance. And, for a long time I felt there couldn't be, how could there be sustainability if, finance is not involved in this? And I believe that the exciting thing is that we're celebrating the 10th birthday of finance coming to the table.
And Catherine, what steps do you think investors can take to achieve a greater impact and in support of these principles?
So I was convening with my colleagues over the last couple of days to sort of ask exactly that question, and sort of what are some of the things that we've learned along this journey, and collectively really came up with a handful of things. The first one is this issue of data that we've talked about. That the data just isn't where we would hope it to be yet, which means you have to have an ability to do an awful lot of independent research and analysis yourself, and if you can't do that, you have to partner with someone who can. The second thing we learned, and I think I mentioned this earlier, is that our data analytics and research would tell us, and I think actually a lot of the industry research would tell you, that the E, S, and G factors don't move together. They're actually quite different. And you have to think about that from a return perspective. The third thing we learned as we started really looking at all the data is we realized that some of the ESG strategies out there don't actually necessarily have a fiduciary objective. Again, our clients are fiduciaries, and so that fiduciary objective is very, very important to us. And I guess the last thing that we learned was, and this should be obvious, but we learned it, so I'll state the obvious, which is that you always, as an investor, have to be able to separate what you want to believe from what you can demonstrate you think is the case. And again, it comes all the way back. It comes back to where we started with data and analytics and the ability to really develop your models and test them, as you said.
Thank you. Judy, with the fiduciary retirement rule being digested by the industry, what is the Department of Labor focused on now?
Well, we're patiently listening to the chatter. And I would have to say that we're preparing for, in the fiduciary rule, that there's going to be a period before the rule becomes applicable, and our ability to interface with the community to provide good regulatory support. Because if there are systemic questions where people say, I don't really understand what this means, we're going to need to provide guidance. But there's another area where the department is focused, and it's related to the issue of the transformation in the retirement business. And I wanted to just share some data because I think it's interesting, being a data person, because what we care a lot is people being prepared to retire. So it's good that we can optimize their investments, but if they don't have any investments, we worry. And what we've learned, what we certainly know, is that people who are covered by some kind of a retirement plan save more. And I was going to share with you that ERISA was passed 40-some years ago. And at the time ERISA was passed, we looked at, I happened to work on a Carter Commission on pension policy back then, so we were looking at the issue of who was covered by retirement plans and who wasn't. I thought you'd find this interesting. In 1979, we looked at who was not covered by a retirement plan, and at that time, 54% were men, 46% were women, 71% worked full-time, 29% worked part-time, 29.9% earned less than $5,000 in 1978 dollars, and 79% of the people that weren't covered by plans worked for firms with fewer than 100 employees. So it's women, low-wage earners, part-time workers who work for small businesses. So now I want to give you the data today. This was 2014. 53% were women, 53% were men, 47% were women, 74% worked full-time, 26% worked part-time. That was versus 29. 24% earned less than $14,000, which was the equivalent of that 1978 $5,000. And 54% were in firms with fewer than 1,000 employees. So I know you don't have the chart in front of you, but it says in the 40-some years we've been doing this, we haven't moved the needle all that much. And so one of the things that the Department of Labor is working with is various states, because we haven't been able to solve this with a mandate at a federal level. So we've been working with various states to help them create environments where those who aren't covered can be covered under some kind of a state program. And that, too, will enhance and increase the pool of capital that is there for retirement savings.
It's very interesting data. Wow. Before I go any further, I just want to open it up to the audience if anybody would like to ask any questions of the panelists. Just raise your hand. All right. Well, seeing as none, I'll just proceed with my last question at this point. I'd like to start with you, Geeta, but in terms of looking forward the next 10 years, what do you feel that the PRI's main priorities should be?
I think based on how COP21 worked out, getting everybody under the tent, embedding these issues in the DNA of investing, no apologies, meaning being ambitious and not taking no, so which requires actually being very creative in each environment. In the US, it's the federal and the state and so many other areas, so it's a lot of work. And ultimately, I think engaged investors is meaning bringing back ownership culture to investing would be our best insurance, I think.
And Priya?
So I think Martin mentioned earlier some of the things we're struggling with. The diversity of our signatory base and sort of what the areas that we're hoping to permeate further, such as Asia, for example, the US, where some investors, some asset owners, some investment managers might be a little earlier in their evolution on these issues, and then the tension between that and sort of the accountability question. How do we ensure that those who've signed on to the principles are actually doing what the principles say? Are they actually integrating ESG into their investment decision making? Are they actually promulgating these principles in the investment ecosystem? And so this is a real tension that we're grappling with at the moment, and I think that is sort of the key, is how do we strike the right balance between ensuring that we have a big enough tent that we can bring new people in and help move this, gain further momentum around this without greenwashing, without dumbing it down so much that we're sort of allowing those who wanted to say that they're doing something, but to say that without actually putting their money where their mouth is. So I think that is a critical, we're at a critical juncture right now in that respect. And then there are, I think, Geeta mentioned climate change, obviously the need to actually see the COP21 agreement sort of come to some kind of real fruition in terms of implementation and deliver the promise is something that PRI can be engaged in and should be. Income inequality, I mentioned earlier, I think is a real issue that investors are grappling with that we don't yet have the answers to, and so there's a need to sort of convene people around issues like that, and I'll leave it there, I think.
And Judy?
I would say two things. They both start with A: amplification and accountability. I think there's a very loud voice that can be heard, and I think PRI has been a very powerful force for amplification. And I would encourage that continue. The second in my mind is accountability. I was very impressed with the number of people that had signed on to the principles. I was very unimpressed when they didn't have to be accountable for their signatories. And that I think understanding what does it really mean to your investment process, and how are you accountable for what you've signed on to, and what should it mean to me as an investor, is an area where I'd encourage more work.
Yeah.
And I guess I would maybe speak to it from our perspective as a signatory and an investor. I sort of see us as moving from an era that I think of as kind of aspiration and principles focused, obviously the 6 principles of the PRI, but sadly moving from aspiration and principles to perspiration and hard work, because that's what we've found is really involved if you're going to tackle this as an investor. It is about data. It is about building models. It is about assessing risks and return and transition costs, regulation, taxation, stranded assets, stranded business models. These are very big and hard things to assess, and I see us as moving, and certainly at our firm, that's where we are. That's what we're doing.
Just to hit on the point of accountability, you mentioned earlier just in terms of sort of gauging the different groups of your investors that are have different views on how to approach fossil fuel companies. I'm just curious, like as you get to a result, and in that case was a middle ground, what is the level of accountability that maybe some of you can just say that you provide to your constituents or investors to make sure that you are living up to these standards and fulfilling that, and then obviously showing it as well?
So when it comes to fossil fuels and carbon footprints, we would be able to give them the carbon footprint of their portfolio, for example.
And Priya, with Calpers?
Sure. So we produce periodically, about every year to 18 months, a sustainability report that is publicly available. And as you probably know, all of our board meetings are held in public on a monthly basis, where we are constantly having these types of debates, discussions, dialogues around how best to move forward in a way that it will both deliver returns and have an impact. And we're continuing to evolve that work and doing it in a very transparent way.
Yeah, and we report almost all the time to our clients about our efforts. We also create templates on the Montreal Carbon and so on those kinds of footprint. But perhaps equally importantly, we spend a lot of time. I'm very aware of it because we just finished our PRI report. And so I would say that's another very big part of reporting that will create the impetus to have those performance indicators, have both to meet standards, but also to differentiate and raise the bar. So to allow for leadership, creativity, and innovation to take us to the next step.
Great. Well, we just have a couple minutes left. We can close it up, or if anyone has any questions, sure.
Just a question about asset allocation. There are a lot of studies out. Jonathan Naiman, Light Green Advisors. Hi, Geeta. Just a question about asset allocation. We've had a lot of discussion about how much money is needed in terms of resources and UN reports, et cetera, for green infrastructure. And it strikes me, if we're talking about data and carbon footprinting, we're sort of avoiding the opportunity to allocate capital from responsible investors to the green infrastructure, which the UN and other bodies have said is required. And so I would just respectfully suggest that we begin having a discussion about asset allocation as well as footprinting, since it's the dynamics to some extent that the capital markets can contribute to this.
Thank you.
Absolutely. I think we shortchanged all the other asset classes and their solution potential, which may vastly outweigh that of marketable securities, even though a significant portion of investors' portfolios may be in marketable securities. Well said.
The most rapidly growing sections are not in the marketable securities.
Yes.
So, one idea for the PRI's next 10 years may be to place a little bit more. One idea for the next few years may be to place a little bit more attention on non-marketable securities.
Thank you.
And also on. I'm sorry about that. No, I was just saying that one idea may be to place a little bit more attention on non-marketable securities, private equity, and in particular the greening of infrastructure. We have an infrastructure deficit in the U.S., and to some extent we may need some innovative investment which will require new structures as opposed to old data to structure. So if you think about making cities more efficient, the capital for that can't all come from the tax base. And institutional investors have a role to play. And
Absolutely.
I'm hoping that PRI will engage with firms like ours as we look at that in the future.
And we would agree with you on that. Again, our clients are institutions, long-term investors, and so they tend to have a large allocation to private capital, illiquid investments. And we would agree, in the energy space in particular, lots of opportunities with renewable generation, energy efficiency, sustainable timber, agriculture, all things that can drive returns, but also drive change over time.
Thank you. Any other questions before we? Yes. Sorry.
Geeta and Priya being on the board, I know that the board of PRI is working very hard looking at how members act with integrity and don't just use the PRI label. And I was wondering if you could talk a little bit about how members vote their proxies as part of that discussion. And maybe, Catherine, you could say a word or two about how the Commonfund is voting its proxies. I know that's been a discussion over the years. Thanks. Thank you.
Well, I don't know that we as a board, we haven't gotten quite into that level of detail. We're still sort of in the consultation phase, talking to signatories about what they would like, what they think is the right balance, and then then we'll get further into sort of the details of what that would look like, what an accountability regime might look like.
And at Commonfund, we invest through other managers, and so as a signatory to PRI, we work with them, guide them around proxy execution, but they do that for us.
And clearly that is incorporated in the reporting, the reporting framework. So it's already captured there. And so the question would be, if we're allowing new people in, how long should we give them, new entities in, new signatories, how long should we give them before they have to reach a certain level of performance, a certain grade, so to speak? Or do we have a second tier of signatory that might not have to do the reporting in the same way? Or, so these are the kinds of sort of broad, high-level questions that we're asking at the moment.
Thank you. So it looks like that's all the time we have right now, and I want to give a round of applause for our panelists.